Hi guys, good afternoon and welcome to Mutual Fund Corner. I'm Pavitra, with me is Sonal, and today we're going to discuss the new Motilal Oswal passive microcap fund, right? This is an interesting space because we've seen a lot of interest in the broader markets, right? We've seen that in the flows that we track every month as well. And I'm interested to see what the team has to say about it, because this is the first fund of its kind and really provides a whole sort of different category to retail investors.
Yes, passive microcap funds, right? Important to know more about it. So let's get in Mr. Pratik Oswal, who's the head of passive funds at Motilal Oswal Asset Management Company. Pratik, good afternoon. Thanks a lot for joining us on CNBC-TV18. Well, that's basically the first question. Why launch a microcap passive fund through this category while we do have the other ways as well?
Yeah, good afternoon, and thank you for having me on the show. I think as a category, there's been a lot of interest coming from all of our investor base, towards investing into smaller and microcap companies. We were actually one of the first AMCs to have launched broad-based index funds across all categories back in 2019. And we see that there is a similar demand for, I think, funds that people or investors who are looking at investing in microcaps. This segment is actually very, as a category, it's, very under-researched. And as a result, it's also very under-owned by investors as well as by the mutual fund category itself. I think if you look at the overall mutual fund industry, less than 4% of the mutual fund AUM is invested in this category. And the primary reason to that is because very few analysts cover it. In fact, in the fund that we're launching, almost 45% of the stocks have zero analyst coverage. So I think for anyone who's looking to play in this segment, I do feel that an index fund or a passive fund can make a lot of sense for investors who are looking at the segment.
But Pratik, why? Because outside of the large cap index, whether you look at mid caps, whether you look at small caps, actively managed funds do outperform, right? Only in the large cap space, I know that fund managers find it hard to beat the index for a lot of reasons, because you have caps on the kind of sector exposure, you can have stock exposure that you can have. But for mid and small caps, you do have active funds which mostly always beat the passive. So why would that not be true for micro caps?
Yeah, so I do agree. Honestly, there will be. So I have nothing against I think outperformance and underperformance. The thesis behind passive funds is to really make investing simple for investors. For an investor who's looking to buy a mutual fund today, for them to have to choose between, say, 15 or 20 or 25 small cap funds, a simple index fund that's tracking the small cap to 50 index works really well for their long-term goals. In fact, if someone had to invest for, say, 25, 30 years, someone who's 25, 30, for them, it really makes sense for them to go for an index fund, because it's really hard to really project which fund will do over such a long time. So I do think that passive funds make investing very simple. When it comes to the microcap category, I do agree, there is a lot of opportunity for stock picking, for alpha generation. But I do feel that these companies are very small in nature. So building up sizable positions in these companies becomes extremely difficult. That's number one. And also, number two, there is no mutual fund today out there that is giving investors exposure to this side of the market. So we believe that, I think having this fund there, it really makes it easy for investors to access this type of category. Today, only AIFs and PMS alternative products offer this, but this will be the one product where an investor coming in with 500 rupees is able to buy into this segment.
Okay, so a retail investor will be able to do that via investments in this category. So tell us, what have the returns looked like, say, on the mid cap, small cap and micro cap index over 3 and a 5 year period?
Yeah, so returns in a mid and small caps have been quite good, at least over the last 3 to 5 years. I think if you're looking at mid caps over 3 years, it's delivered close to 30% plus, even small caps. So I think we've seen a very good run for mid and small caps securities over the last 3 to 5 years time. So I do believe that investors are also sort of taking heed of sort of the outperformance that you can get. Ideally, in theory, mid caps should ideally outperform large caps over the long run, because you are betting on smaller companies. And with that, obviously, you expect smaller companies to grow at a slightly higher rate or at a slightly faster rate. So I think investors have also seen that, but also this comes with a lot more risk. So investors will have to keep that in mind when you're looking at investing in small and micro caps. So in terms of the micro cap index itself, We've seen that over a 3-year period, this index has delivered close to 58% returns. And even over a 10-year basis, it's delivered close to 23-24% returns, CAGR. But honestly speaking, I do believe that point-to-point returns is something that investors should not really take into consideration. This sort of a fund is very volatile. So we do recommend investors to take a staggered approach when investing in this particular index because it's very hard to really time the market. And by having a staggered approach, you're ensuring that your return profile is a lot more sort of consistent over time. So you'll see that this fund is sort of volatile in terms of returns. But on an SIP perspective, you'll see that this fund over a 3-year or a 5-year or a 10-year perspective will give you about 20-25% is what this fund has delivered. So I think this part of the category is very volatile, and I think to curb the volatility, a systematic-based investing plan is a great tool for wealth creation in this segment.
Okay, that point is taken and, makes good sense for an investor getting in because like you said, while the returns can look superlative during some periods, the drawdowns can be just as bad, when the market is not doing well. Pratik, passive funds in this space is surprising because, the index does see a high churn, right? And that would force a fund like this to rebalance regularly and, consider an illiquid market. It could be a tough task to do. Your thoughts on this? Because this has been one of the concerns that we've had after we heard about the launch of your fund.
Yeah. I mean, this is actually one of the main concerns to why we haven't launched this fund earlier. So I think what we've seen over the last year or so is that markets have become a lot broader. Your average microcap company today is 3,500 crores in market cap. And this used to be maybe 1/3, maybe less than 1/3 the size 4 years ago. So I do feel that market breadth has improved. We in fact launched a small cap fund, index fund back in 2019 when the size was slightly bigger than what we have today. So we have a good track record in managing these sort of, funds. And we believe that even the market depth has increased. So let me give you an example. Today, we have 250 companies in this index. And the average sort of trading volume that you see of each company is about 5.5 crores. So you're looking at 500 to 600 crores of volume just in this segment. Which makes it quite scalable, to be honest, at least for the first 6 to 8 months' time. And as an AMC, as a fund house, obviously we are, our first sort of priority is not really AUM, but actually efficiency. In index funds, it's very important for the end investor to get returns that are in line with what the index delivers. So I think if we do see that, managing this fund is getting harder, we would obviously curtail inflows through lump sums. But for now, we don't see that happening for a minimum of 6 to 8 months.
Okay, so we'll be tracking that for sure, Pratik. It's an interesting chat and we'll continue this on the other side of this very short break and discuss about this new fund that Motilal Oswal Asset Management has launched. Stay tuned for that. Welcome back. You're still tuned into Mutual Fund Corner on CNBC-TV18. We still have with us Pratik Oswal, Head of Passive Funds at Motilal Oswal Asset Management Company, and we're discussing about the new category, Passive Microcap Fund, that they have just launched. So Pratik, we have been talking about some of the concerns and microcap stocks often don't have big free floats, right? You did speak about the volumes being at around 5.5 crore rupees. But do you think that is something that could pose a challenge apart from the churn answer that you just told us?
Yeah, so in terms of liquidity, as I said, I think yes, that is a concern in this space. But if you look at liquidity, it keeps improving over time. So when we launched a small cap index fund in 2019, we had similar constraints with us, and we've actually been able to. If you look at the tracking error of a small cap fund, that is about 0.16% for the last 1 year, and probably the same last 3 years. So we believe that, we've obviously, and we manage about 27, 28 funds, across geographies, across asset classes. So we believe that, we're sitting at a very similar juncture that, what we saw in small caps in 2019, 18. I think small caps, if you see, have grown about 3.5 times in the last, 3.5, 4 years time, versus large cap, which is 1.5 times. And with growing sort of companies, you also see growing volumes. Yes, and obviously this fund is something that we expect to launch, we expect to maintain for a very long time. Back in the day, say 4 years ago, you never thought a small cap fund could be 30,000 crore. The largest small cap fund in the industry today is 30,000 crore. And I think we believe that, this could be say, microcap, say 4 or 5 or 6 years from now. So I do believe that, yes, liquidity has improved a lot, and an average company trading volume is big enough, for this fund to generate and track returns efficiently well. That's number one. Most important is that, this index is actually very well distributed. What that means is the largest company in this index fund is only 1.5%. So because you're holding 250 companies and because your largest company is only 1.5%, you don't actually need a lot of volume on any particular stock on any particular day. And yes, because there's 250 companies, the smallest company in this index, if you have, say, 100 crore fund, the amount of money needed for me to buy the smallest company is only 9 lakh rupees. So, so what we feel is that, companies have become larger, and also because this index is a lot more well distributed amongst the 250 companies, we feel that we'll be able to do a good job of making sure that this fund replicates the index very well.
Okay, got it. So you don't think the 2% tracking error limit that SEBI has will be a problem at all in this space? I think you mentioned, right, for the small cap, it's 0.16, which is way below it. So you think, it could be similar levels for this one?
I don't think it's going to be similar levels. I think small caps, when we first launched, the AUM of the fund was quite small. So I think when we launched, it was on the higher side. But, over the course of the 3 years, tracking error is something which stabilizes over time. The fund needs to complete a couple of years for the fund profile, the stocks to stabilize. So yes, investors can expect a higher tracking error for the first year or so, and after that, we hope that when the fund completes 3 years, it should come to that level. Essentially, globally, tracking errors ideally seen from a 3-year perspective. So we believe that even investors looking at index funds should see it from a 3-year perspective, because that gives us enough time. And also, most equity investors should be invested in a fund for minimum 3 years. So I think tracking error should also be viewed in the same fashion.
Okay, so we will track that as well. But Pratik, we come back to some of the other ways we can or retail investors can invest in small cap funds. Is a lot of small cap funds. They also have decent micro cap exposure. Do you think that is a better way to get in on this opportunity, or do you think there needs to be a separate category altogether for this segment?
Yeah, so I do agree. I think a lot of small cap funds do have exposure towards micro cap stocks. But if you look at the percentage exposure, it's still on the smaller side. In fact, I would say most small cap funds have some mid cap, some large cap exposure as well. So the only place where you're able to play a pure small cap fund is to a small cap index fund, because it's 100% small caps. Whereas if you want to play micro caps in at least 100% fashion, then I think the micro cap 250 makes a lot of sense. But yes, I think small cap funds do offer it, but they may be maybe 20% or 30% exposure, which may not, ideally play to the strengths of what the micro caps can deliver over the long term.
Okay, Pratik, since we are talking about a high-risk product, I want you to take our viewers through some factors that you should just consider before getting in, right? Because, of course, this is not a product that will be suited to everyone. Like you mentioned, you should have at least a 3-year investment horizon. But anything else that you would just like to sort of warn our viewers about?
Yes, absolutely. And this is the most important bit, to be honest, because you're playing through microcap stocks. So, I think, anywhere where there's higher volatility means higher risk. So anyone investing in this fund should have a high tolerance to risk. But that means a high tolerance to volatility or even drawdowns. So if you look at this index over the last 10 to 15 years time, yes, the drawdowns will be a lot more painful than what you would see in large and mid caps. So I think investors who have a higher risk tolerance should ideally go for this index. Yes, I think there is a myth that you can never make money on microcaps, or they're actually penny stocks and all that. But I do believe that from a wealth creation point of view, the one good way to curb volatility is to stagger investments or do an SIP. So I do believe that retail investors who are looking at this fund, ideally the recommendation would be to stagger it out, because this fund can be volatile. If you look at the return profile of this fund, over 3 years is different, over 5 years is different, over 10 years it's different. So I do believe that SIP is a great way to go, and you should look at it from a minimum of 5-year perspective, because small cap tends to be very cyclical, and I think 5-year horizon is a good horizon, probably more than that, for you to really see the sort of sector or this category to go. So again, for slightly more risk taking, but you can create wealth in this segment if you are disciplined and if you're able to tolerate the drawdowns.
Okay, that point is well taken. Thank you, Pratik, for joining us and explaining to us all about this new category, who can invest into it, and answering so patiently some of the risks as well. With that, we'll do one thing, take your leave in this edition of Mutual Fund Corner. Stay tuned for Closing Bell to take you through the last hour of trade.